Hey, what's up, guys? Welcome to Accounting with Karim. Before we get started, as always, honesty and integrity builds credibility. And so, for this video, we're looking at GAAP. We're looking at some principles with some basic definitions. I was going to say basic principles. Yes, basic, but I don't want to take away from the significance of the principles themselves. So, I'm just saying, hey, these are some basic definitions to these principles. There are more reasoning behind these principles than I will give right now. This is just an introduction to these principles, right? So we have the revenue recognition principle, the matching principle, cost principle, the full disclosure principle. Those are four. I also have four assumptions. We have the going concern assumption, the monetary unit assumption, the economic entity assumption, and the time period assumption. So once again, basic definition, right? So revenue recognition says that revenue is recognized once earned. And so now we have to define what is earned. So earned means that when the service is provided or when the service is provided or when the good or goods, have been delivered to your customer, right? It's not necessarily when the cash or money is received, right? And so the matching principle says that your effort that you put in to generate revenue, like all your effort should be tied towards your outcome, which is your revenue that you generated. And so that is the matching principles. For example, in the month of May, you provided services to company A, provided services to company B. The effort that went into providing those services, even though you might pay those services for those services in July, you have to expense those services in May, right? Then we have the cost principle says that assets are recorded at their historical cost. That is the cost principle. And so again, for example, acquisition of equipment for, $100,000 this year. Next year, we look at the market price for the same equipment. It's $150,000. We cannot record the asset at $150,000. We have to still use the $100,000 to record the asset as in the financial statement, right? Then we have the full disclosure principle, which says that all relevant information should be provided to the users of the financial statement. So any information that is relevant, it is relevant because it would make a difference in the decision that the user is making. Or it would influence whatever decision that person make or does not make. Then we have the assumptions. The going concern assumption says we're making an assumption that the entity will exist in the foreseeable future. So the entity will be in operation in the foreseeable future. That is the assumption that we're making. We have the monetary unit assumption says only transactions that can be expressed in a dollar amount can be recorded. So, we might have amazing employees, but doesn't have a dollar amount, so cannot include that into the accounting system. Economic unit assumption. The economic unit assumption says the company and the owner is different. They're not the same. So all the activities of the company should be kept separate and distinct from the owner. Then we have the time period assumption, which means that accounting periods are broken down into artificial time periods. So, we have the annual time period, which is called a fiscal year. We have the interim time periods, which is like a monthly and quarterly, right? And so the reason for this, or the reason why this is done, is because we're trying to provide timely information to the users and also relevant information as well, right? Because if you would have to wait annually to receive information about how the company has performed, right? That information in some instances can become irrelevant, right? So that's why we have these, different time periods. And so that is it for this video. As always, honesty and integrity builds credibility. Until next time, see you guys.